And I think that the next move higher, I mean, what we saw here this time around was the first leg of a massive leg higher. And I've said before, I don't see any problems in $25,000, $30,000 or $35,000 per ounce going into the next, let's say, 5 years. Because if we look to the phase that we are coming into, this is what is important. This is not just about that we are in a phase where there's been little inflation this time around. We had, a spike in inflation and people were, that's why gold goes up. Now, we're actually seeing a lot of disinflationary pressures now coming out from the housing market, from the labor market. I know that the numbers need to go through the BLS and all the, economists need to understand that, but there is a lot of the disinflationary pressure. And that will not be great for precious metals. But the longer term outlook here is that if I get it right that you're going to see a bust, then the Fed will come in. That goes without a doubt. They will come in. They will try to do their magic again.
Global financial markets are approaching a massive turning point as shifting liquidity forces a broad repricing across asset classes. While precious metals have experienced strong upward momentum, underlying market cycles point to extreme volatility ahead. Henrik Zeberg, a prominent macroeconomic strategist and cycle analyst, projects a dramatic sequence of market movements across the commodities landscape. Over the next 5 years, long-term valuation models forecast gold surging to historic targets between $25,000, $30,000, and potentially $35,000 per ounce. Before reaching these parabolic highs, gold is expected to pull back to at least $3,100 per ounce during an incoming deflationary bust. This phase will subsequently transition into severe stagflation, driving persistent inflation rates between 5% and 6% alongside nationwide unemployment climbing to 7%, 8%, or 9%. Furthermore, a severe liquidity squeeze is projected to push the US dollar index up to 120, triggering a steep 60% plunge in silver before the broader secular expansion begins. Now, we present the clips from Henrik Zeberg's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I think you're going to see at least 3,100 on gold as a minimum, and I could also see it lower. But I think you're going to see a bounce now, and there will always be a narrative associated with any development in the stock market. For better and for worse sometimes, because the narratives can be horrible. But there's no doubt. I mean, I am actually myself beginning to buy more now physical gold and silver at this point. And I do that because I think, we've seen this, how it took off, and we now see that it corrects. But I think that correction can be rather fast going into maybe early next year. I don't think it will be, a good thing to hold for the period where we see the dollar coming up. And I don't think that the central bank or China buying it will be enough for this, because in a world where the bust comes out and you see a lot of businesses believing they have, a lot of values and assets will start to plummet in terms of value, you will see that there will be a dash for cash and the dollar will be what you pay for. You don't pay with gold, you don't pay with Bitcoin, you don't pay with anything else but the dollar. And that's what we need. It's not because of the particular strength of the dollar, it's because of the setup we have where we all are kind of short the dollar in this euro dollar world we're in. So I think that is the reason we will see the decline, and it will not be enough for a few central banks to buy this, to buy gold. Will it bounce? Yes, and that's been my expectation. I could see even all the way up to very close to where we saw the top, maybe almost like a double top. But the decline when the dollar reaches or moves into its strong bull phase, I don't think it's going to be nice for precious metals. But it can be swift. And I think that the next move higher, what we saw here this time around was the first leg of a massive leg higher. And I've said before, I don't see any problems in $25,000, $30,000 or $35,000 per ounce going into the next, let's say, 5 years. Because if we look to the phase that we are coming into, this is what is important. This is not just about that we are in a phase where there has been little inflation this time around. We had, a spike in inflation and people were, that's why gold goes up. Now, we're actually seeing a lot of disinflationary pressures now coming out from the housing market, from the labor market. I know that the numbers need to go through the BLS and all the, economists need to understand that, but there is a lot of the disinflationary pressure. And that will not be great for precious metals. But the longer term outlook here is that if I get it right that you're going to see a bust, then the Fed will come in. That goes without a doubt. They will come in. They will try to do their magic again. The problem is the Fed does not hold a magic, stick there. They cannot make people buy, and they can make the incentive for it by pushing rates down. And then they can hope that you and I and Mrs. Johnson there will start to buy, and they will not only will buy, we will actually, borrow extra money and buy something more, buy a new, house or whatever we do. That's their hope. But when that doesn't happen, and the reason I think it will not happen as fast this time around is because the consumer has become as under more pressure than we have seen in a long time. If you look across the numbers, it's probably one of the worst situations we have seen for an extended time for the average consumer in the US. And then if you've been under pressure for a few years, you're not so likely to go out and spend the money that you all of a sudden save on your mortgage loan. That's why there is something called psychology in economics, that which I think the Fed sometimes forgets, and especially the financial world forgets. This is not something magic that the Fed can do to the markets and just start pumping them up. The markets will react because they think that the economy will do fine, but it's really down to the consumers whether they start to spend. And if they do not, or they kind of hold back a little because of what they have seen with inflation, with, maybe if, as I say, that unemployment rate is coming up again, and the number of people, they have been finding it hard to finance their homes and so on, which is also the situation right now. You don't jump out the next day and say, oh, great, jolly, let's go. Let's start buying stuff, right? You will wait a little while. You'll say, well, you know what? I just saw inflation. I saw this, and that. I'm going to hold back on these $100 I've saved every month here. I'm not going to spend it. That's the problem with QE. That's the problem with the monetary policies and easing, is that you do not know how fast the consumers will take it in and start spending. And in that environment, you can actually see that the money can start to rotate, because there is, different layers to inflation. There can be asset inflation. There can be, consumer inflation there. And there can be asset inflation in that environment. I could see that the money will find its way into commodities, and I could see that there will be a speculative bubble coming in commodities in the next phase. That will drive the numbers up, and it will look like we have stagflation. There will be stagflation. We can have inflation rates at 5-6% for an uncomfortable long time, and also the unemployment rate at 7-8-9% for an uncomfortably long time. In that situation, there's not much the Fed can do. And in that situation, you're going to see commodities doing extremely well and precious metal doing really, really well. We have not had stagflation this time around. People are talking about that, but you don't have stagflation at 3%. That's simply stupid, because if you go back 20, 30 years, you'll see that inflation levels have been around 3%. They're never down at 2%. They've been there a short time over the last, says 10 years, but not in the last 20, 30 years. But it's that stagflation environment that I just described before. You had really that in 77 to 79. And there you saw gold coming up really fast. And when we talk about fast, we talk 5 times in a matter of a year and a half, 2 years. That's when you have a really big development. And I think that phase, we could be going into that phase after we have had the bust. And this is what people find so difficult. So why not just, jump right in? And as I said, I'm dipping my toes into physical gold and silver right now. But I will still say, I don't know that it's probably not going to be the best timing, because I know that we can get it, and I will be buying bigger and more at that point, and maybe something that related to gold miners and silvers. But the situation is that the environment we go into the next 5 years can easily bring gold up to 25, 30, 35,000. So easy to make that calculation.
Central bank monetary easing and interest rate cuts will struggle to revive economic growth once a broader downturn begins. Household balance sheets have been severely eroded by years of cumulative living costs, leaving consumers cautious and unwilling to take on fresh debt or finance major purchases. Monetary policy relies heavily on consumer psychology, which quantitative easing cannot artificially force. When lower rates fail to generate real commercial demand, surplus liquidity rotates away from paper assets and into physical resources. This structural shift sparks intense speculation across raw materials, creating a scenario where input costs accelerate even as broader economic output stagnates. Financial institutions often overlook this psychological barrier, assuming rate cuts will automatically restore consumer activity, when in reality, prolonged financial strain delays spending and pushes capital directly into tangible goods. Now, let's get back to the interview.
The gold does well in an environment where people expect inflation. So we saw that there was this, we have the late phase, which we are now very late in. And in that phase, you often see inflation pushing up. You see yields pushing up in that period. And we have the chit chat about now inflation is back and there's nothing, the Fed can do about it. So you need to jump into gold and silver. And gold and silver had their fantastic rallies, and it was clearly, a blow off into that phase. So they went up, like crazy into, I was 120 on silver, which was, crazy levels compared to where we are in the cycle also. And that silver is really also an industrial, commodity. And when all of a sudden then people realize, hey, why are we then buying into this? Why don't we then start to buy some risk again? And now then people rotated. They started to buy into risk again. And you saw then that risk assets again started to take off. And I was expecting that also, that we saw that. I didn't see the gold or silver going this high. Now people are again seeing this small, inflation bounce, and we see oil, gold and silver then doing a little bounce here. Well, this is because they were kind of oversold in this environment we have had. So I do think, and I obviously expected that also in a few tweets, saying I think we can see gold and silver actually coming up quite, bouncing quite well here. I don't expect a new high. I would be surprised to see a new high on the gold and silver because we are still in a risk-on environment. So we are not in that. It's inflation that is going to drive it all. We are in where risk assets is going to do well. So I think it's a bounce. We never see straight declines. We always see that there is a bounce, and they can be for short or longer time. But I think this one could be, going into September, October, maybe even longer. But the strong dollar environment that you mentioned also, when we see the bottom of the dollar, I think you're going to see a reversal again and the final bust of the gold and silver, which I've been saying all along, which the strong dollar that I see with the Dixie at 120, that is not an environment where, anything related to precious metals, will be a good place to be. Precious metal will suffer in that environment. And that will bring them down to a level where they can be very interesting to buy from a trading perspective, maybe not from a long-term holding, because there's a different side to that to hold it, for longer. And that's completely different. So I think you're going to see that they will bounce here now for as long as the dollar as it declines. And as it reaches the 93, 94 area for the Dixie, you're going to see, also the silver and gold find a new lower top. And then you'll see the decline when the dollar starts to rally. That rally will be so difficult for people to see, but that is what we see into recessions, and I think this time will not be different. I don't think it's so much about the technologies. I mean, yeah, of course there can be something to that, and people would like to think about that narrative. But to me, it's really about the business cycle where we see that there is a slowing of the economy. That means that there's a slowing of production. There's a slowing demand on the metals, on the whatever commodities that will be used for production. So, and that is what we see. I know that there has been a bounce and a hype, and everybody thought that now this is taking off once again. But I think we've seen when it comes to the secular bottom in commodities on a general basis, I think we had the bottom in 2020. We saw a strong rally going into, when was it? We had the top last this year, actually, this year. And then I think we're going to see that very strong pullback now as the dollar starts to strengthen. And there, silver and gold will go hand in hand there. I don't think there will be any reasons why we would see one or the other. I mean, gold will normally not decline as much as silver, and I think silver will have that industrial component, which is not a good thing into a deflationary bust. So I think silver will see quite a big drop. And 2008, in the situation, if we compare it to what I'm seeing here in March of 2008, we saw the Bear Stearns. We saw that there were the dash for cash actually began there. We saw the dollar starting to move up. It went up 20%, 22, 25. I can't remember how much it was into October. And that was the problem, because when the dollar goes up by that much, in such a short time frame, you'll see the rest of the world is crumbling. And in that environment, we saw silver dropping by 60%. We've seen silver going to 120, which was a crazy price on silver at this point, right? It was in a phase where everybody thought there would be inflation. And everybody was talking more about that. And it was the narrative is, pumping itself up. And I talked about this small speculative bubble we had in it.
The underlying architecture of the global euro-dollar system creates extreme vulnerability during periods of macroeconomic distress. Because international trade and corporate liabilities are overwhelmingly denominated in greenbacks, global market participants operate in a structurally short position against the dollar. When economic growth decelerates and corporate balance sheets deteriorate, businesses and institutions execute an aggressive dash for cash to cover outstanding debt obligations. During a systemic liquidity squeeze, Gold, digital assets, and physical commodities cannot substitute for currency when settling immediate liabilities. Even persistent central bank bullion accumulation is insufficient to counter global liquidation pressures. The metals sector experiences asymmetric pressure during this phase. While gold retains its monetary reserve status, silver suffers compounded losses due to contracting manufacturing and industrial demand. Understanding these structural mechanics is essential for separating short-term trading volatility from generational accumulation strategies. While liquidity contractions enforce steep cyclical drawdowns across physical assets, they simultaneously clear the imbalances necessary to establish the foundation for enduring physical asset supercycles. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.